Can a brand new Amazon seller, fresh off the digital boat, really secure funding from the e-commerce giant itself? It's a question that echoes in the minds of countless aspiring entrepreneurs, a whisper of hope for those staring down the initial investment required to launch their Amazon dreams. You've probably heard the buzz about Amazon lending, seen the headlines about sellers receiving millions, and thought to yourself, could that be me? Even with zero sales, zero reviews, zero history. It's a tantalizing prospect, isn't it? The idea of Amazon, the very platform you're trying to establish yourself on, reaching out and offering a financial hand. It feels like a shortcut, a way to bypass the traditional hurdles of small business loans, or the often stifling terms of private investors. But let's peel back the layers of speculation and get to the core of the matter. Is Amazon lending a magic bullet for new sellers, or is it a privilege reserved for the seasoned veterans of the marketplace? To truly understand if you, as a new Amazon seller, stand a chance of securing funding, we need to first understand what Amazon lending is. It's not a traditional bank. It's a bespoke financing program offered by Amazon to its third-party sellers. They don't just hand out money willy-nilly. Their primary objective is to empower sellers to grow their businesses on Amazon, thereby increasing Amazon's own revenue through commissions and fees. So, right off the bat, you can see a direct correlation between your success and Amazon's interest in providing capital. Now, imagine Amazon as a very sophisticated, data-driven lender. What do traditional lenders look for? A track record of financial responsibility, consistent revenue, and a clear understanding of the business's health. Amazon, with its unparalleled access to your seller data, is no different. They scrutinize your performance metrics, your sales history, your inventory management, even your customer service ratings. This data forms a bedrock of their lending decisions. And here's where the challenge for new sellers emerges. If Amazon relies heavily on historical data to assess creditworthiness, what data do you, a brand new seller, have to offer? The answer, unfortunately, is very little. You have no sales history on Amazon. You have no established inventory turnover rate within their ecosystem. You have no record of customer satisfaction or return rates. This lack of historical performance is the single biggest hurdle for new sellers seeking Amazon funding. It's not to say it's impossible, but it certainly isn't a walk in the park. Think of it like trying to get a mortgage without any credit history. While not entirely out of the question, it becomes significantly more difficult, requiring alternative forms of proof or a higher degree of risk from the lender. Amazon, while keen to foster growth, is still a business and will mitigate its risks. So, if direct Amazon lending is likely out of reach for a brand new seller, what are your options? Does this mean you're left to scramble for every penny? Or are there alternative avenues to fund your Amazon venture? Absolutely not. Let's explore the realistic pathways to secure the capital you need to launch and scale your Amazon business, even if you're starting from ground zero. Firstly, and perhaps most obviously, is self-funding. This is the most common route for new entrepreneurs. It could be through personal savings, a bonus from a previous job, or even selling off non-essential assets. While it might feel like a slow burn, self-funding offers the unparalleled advantage of complete control. You're not beholden to anyone, and every dollar you invest is a direct investment in your own future. The downside, of course, is that it can limit the scale of your initial launch, especially if you're looking to dive into a competitive niche requiring significant inventory. Secondly, consider friends and family. This is a well-trodden path for many startups. It's often quicker, more flexible, and comes with more lenient terms than traditional financing. However, it's crucial to treat these arrangements with the utmost professionalism. Document everything, set clear repayment terms, and communicate openly. Mixing money with relationships can be fraught with peril if not handled meticulously. Thirdly, explore small business loans from traditional banks or credit unions. While you might not have a long Amazon sales history, you might have a strong personal credit score or other assets that can serve as collateral. Banks will look at your overall financial picture, your business plan, and your personal repayment history. Be prepared to present a detailed business plan outlining your product, market analysis, marketing strategy, and financial projections. A well-crafted business plan demonstrates your seriousness and understanding of the market. Fourthly, look into SBA, Small Business Administration, loans. In the United States, the SBA guarantees a portion of loans made by commercial lenders, making it less risky for banks to lend to small businesses. While you'll still need to meet the lender's criteria, the SBA guarantee can open doors that might otherwise be closed. These loans often come with favorable terms and lower interest rates. Again, a solid business plan is paramount for this route. Fifthly, and increasingly popular in the e-commerce space, are online lenders and alternative financing platforms. These companies often have more flexible lending criteria than traditional banks and can process applications much faster. Some specialize in e-commerce businesses, understanding the unique cash flow cycles and inventory needs of online sellers. However, be wary of higher interest rates and fees. Do your due diligence, compare offers, and understand the full cost of borrowing before committing. Examples include Shopify Capital, those specifically for Shopify sellers, Payability, or other revenue-based financing companies. While they might not be Amazon funding, they understand the e-commerce ecosystem. Think of it as a stepping stone. Your initial funding, whatever its source, is designed to get you off the ground, to make those first crucial sales. Once you have a few months of solid performance under your belt, perhaps even a year, then Amazon lending might become a very real possibility. They want to see that you can actually sell on their platform, that you can manage inventory, that you can satisfy customers. Their lending decisions are rooted in your ability to perform within their ecosystem. So, to answer the initial question directly, as a brand new Amazon seller, it is highly unlikely you will qualify for Amazon lending. They require a track record, and you simply don't have one yet. However, this is not a dead end. It's a clear indication that your focus should be on generating those initial sales, building your seller metrics, and proving your viability on the platform. Once you've established that foundation, the doors to various funding options, including Amazon lending, will begin to open. Your initial funding needs to come from elsewhere, allowing you to build a varied data profile that Amazon will later assess. With that said, thanks for watching, and until next time.